Investing is really not complicated. I mean, the basic framework for it is simple. Now then you have to work at it some to find the best pockets of undervaluation maybe or something. But you didn't have to have a high IQ. You didn't have to have lots of investment smarts to buy junk bonds in 2002, or even to do some of the stuff that was available when LTCM got in trouble. You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified. So you get these opportunities, and you'll get more. I mean, there won't be any scarcity of opportunities in your life, although there will be days when you feel that way.
Already have available in large quantity, and you like it better than 98% of the other things you see, well, you can just screen out the other 98% because you already know something better. So that people who have a lot of opportunities tend to make better investments than people that don't have a lot of opportunities, and people who have very good opportunities, and using a concept of opportunity cost, they can make better decisions about what to buy. With this attitude, you get a concentrated portfolio, which we don't mind. That practice of ours, which is so simple, is not widely copied. There's too much on the television emphasizing speculation in stocks.
The biggest thing, too, is to have something in the way you're programmed so that you don't ever do anything where you can lose a lot. I mean, our best ideas have not been better than other people's best ideas, but we've never had a lot of things that pulled us way back. So we never went 2 steps forward and 1 step back. We probably went 2 steps forward and a fraction of a step back. But avoiding the catastrophes is a very important thing, and it will be important.
Occasional little anomalies, as they would say, in the teaching world. I mean, what you really want a course on investing to be is how to value a business. That's what the game is about. I mean, if you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business, and the rest of it is playing around maybe with numbers or Greek symbols or something of the sort. But it doesn't do you any good. I mean, in the end, you have to decide, whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price, and that's what investing is. And I don't know any other kind of investing, basically to do. And that just isn't taught. And the reason it isn't taught is because there aren't teachers around, who know how to teach it. I mean, they don't know themselves. And since they don't know themselves, they teach something that says nobody knows anything, which is the efficient market theory. And if I didn't know how to do it, and if I ever teach physics, I'm going to come up with a theory that nobody knows anything, because it's the only way I can get through the day, But it's fascinating to me how the really great universities operate in this respect. If you get a sacred writ, I mean, you get in the finance department because you sign on, to whatever the present group thinks. And if they think the world is flat, you better think the world is flat too, And your students better answer the world's flat when they get on exams. I would say investment, finance teaching in this country is in general, is kind of pathetic.
Well, I think the business schools do a pretty good job when it comes to accounting, or personnel management, or there are a whole lot of subjects I think they do quite well with, but they miss one enormous opportunity. If you learn to think intelligently about how to invest successfully in businesses, you'll become a much better business manager than you will if you aren't good at understanding what's required for successful investment. So they're missing a huge opportunity to improve the management profession by doing such a lousy job in teaching investment.
You see, Charlie and I see CEOs all the time who in a sense don't know how to think about the value of businesses they're acquiring, and then so they go out and hire investment bankers, and guess what? The investment banker tells them what to do. Tells them to do it because they get 20x if they do it and X if they don't do it. And guess how the advice comes out? So it's when a manager of a business feels helpless, which he won't say out loud, but inwardly feels helpless in the question of asset allocation, you've got a real problem. And they have not gone to business schools that have given them any real help, I think, in terms of learning how to think about valuation in business.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money. It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you, and you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right. The professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't. In the securities business, you literally every day have thousands of the major American corporations offered you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike call on you. If you get too many calls on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25, and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
So you might not swing for 6 months.
you might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly
By
because
academics, you mean professors of
right,
finance?
the data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Simple.